For a look at some more movers this morning, let's bring in Alex Coffey, co-host of Next Gen Investing. Hey there, good morning, Alex. Let's start with Walmart because that's a big story this morning. Kevin was talking about the soft data. Walmart also gives us some data about how the consumer is faring. Shares of Walmart under a little bit of pressure after it seems like sort of a mixed report here. Fill us in on the highlights.
Yeah, a little miss on the top line. Revenue came in a little bit light, missing by about $500 million. But when you're reporting $165 billion in revenue, $500 million is kind of a rounding error, to be quite frank with you. Adjusted EPS, though, was slightly ahead of estimates for the first quarter. Notably, the Sam's Club ex-gas U.S. comp sales were pretty strong, 6.7% growth on that metric versus a less than 5% estimate. They reiterated their fiscal year net sales growth forecast, 3 to 4%, as well as their EPS forecast between 250 and 260. This was seen a little bit light. The street, I think, thought that might get raised a little bit. Did not happen, falling short of those estimates. Now, initially, the stock did pop. But it has faded. Some of the other headlines made by the company, Walmart's CFO said that price hikes from tariffs may start as early as this month. They do think that despite the tariffs, they're going to hold prices on some of their products. They do say that suppliers are shifting sourcing materials due to the tariffs, and that Costa Rica, Peru, and Colombia tariffs are impacting food. Private label sales, according to the CFO, are outperforming. So, again, mixed bag, I think, is a good way to frame it.
Yeah, I was just looking at some of the headlines here. The CFO said February was softer than expected, March was back to normal, and April was very strong, pointing to improving trends. But I think the fact that the CFO is also saying that Walmart could raise prices in response to those still high tariffs give us a bit more into the potential inflationary picture from these tariffs. We might not be out of the woods here.
Yeah, maybe not. They did say that they're going to try to absorb as much as they can. It doesn't say that they're going to pass on the entire cost to it. They do talk about, again, some of those South American countries where they're sourcing food being a little bit tougher, and that's where some of those pricing pressures are faced. But we're talking about a grocery store, typically a value grocery store as well, low margin business. Not a surprise to see this type of company perhaps having to deal with the cost pressures in that way. But it hasn't happened yet. They do say that it could start as early as this month, so time will ultimately tell. But you can tell from the EPS forecast as well as the comp sales growth forecast that they don't expect it to meaningfully impact their business much at all.
And Walmart did give guidance, so I guess the picture is clear enough that Walmart can give a forecast on what it expects. Yeah, so I think that's also important as we think about what we could potentially hear from other retailers this earnings season. So, Alex, if we had to kind of give a broader takeaway about the strength of the consumer right now, according to Walmart, it's what?
It's always going to be hard to tell when you're looking at Walmart, just simply because Walmart sells so many things that are unavoidable in terms of you got to buy food. And so Walmart typically benefited the last few years when the consumer's wallet was squeezed through the trade down effect. You're starting to see areas like Sam's Club be an area of outperformance. We've talked about Costco's successes over the last few years. So to me, my takeaway is the consumer is still buying the things that we have to buy, but they're maybe looking for ways to be a little bit more value-oriented, maybe going to the bulk, wholesale warehouses a little bit more if they're a member. But all in all, the consumer is not scorching hot, but it's not falling off a cliff either.
Yeah, we've certainly seen the outperforming stocks so far this year in terms of retail be those with a value slant like Walmart, like Costco, Dollar General, Dollar Tree, TJX. So, of course, Walmart kind of kicking off retail earnings season. We'll hear from a whole lot more over the coming weeks. Let's stick with retail, though, because there's a big deal in sneakers and sporting goods, and that's Dick's buying Foot Locker. Foot Locker shares surging on the news ahead of the open. Dick's shares under some pressure. Fill us in on this deal, Alex.
Yeah, approximately a transaction value in equity of approximately $2.4 billion. They see an enterprise value of approximately $2.5 billion. This was announced by Dick's Sporting Goods today. It kind of leaked out, I think, from the Wall Street Journal late yesterday, but it was confirmed today. It's been unanimously approved by the board of directors for both companies, so this has moved along quite quickly. Foot Locker shareholders are going to need to elect to receive either $24 in cash for their shares or a little bit over 1/10 of a share of DKS for every share of FL that they have. It's not subject to a minimum or maximum amount of either. And this is going to be based on the closing price of Foot Locker common stock on May 14th. When you look at this particular name, obviously pretty natural reaction in the shares based off the potential dilution for Dick's Sporting Goods shareholders, and then obviously the premium price being bought for all the shares of Foot Locker. TD Cowen has already weighed in. They downgrade to hold. They call this deal a strategic mistake. They cut the price target from $245 to $216 on DKS. And they say it's a misallocation of capital. They cite risk to the synergies and integration and a clear structural risk to Foot Locker's business. So not the most, lavish praise. If anything, kind of poking at Dick's Sporting Goods, scratching their head at this one.
Yeah, it's not a huge surprise to see the acquirer shares lower, although, and Dick's is actually off earlier lows, saw shares down as much as 17% earlier this morning, down about 11% in the pre-market. But doesn't seem like it's not just TD Cowen that might not like this deal. It seems like investors might not like it either.
Yeah, it's a little bit early to say in terms of what the ultimate impact will be. Like you said, natural to see this type of price action, stocking or company being bought, go up. Obviously, there's a premium price being purchased to buy all available shares. And then, of course, because of the structure of this deal in which there's a potential stock offering to those Foot Locker shareholders to become Dick's Sporting Goods shareholders, there's a dilution element to this as well, which does reduce the value per share of existing Dick's Sporting Goods shareholders. Now, over time, if you believe there's going to be synergies or that this is an accretive deal, there could be opportunity to be involved, and that's where TD Cowen doesn't necessarily see it and actually thinks that the deal, again, is a strategic mistake. So that can add additional pressure to it, or at least weigh on the shares over time as they work to integrate the company into the existing Dick's Sporting Goods universe.
Yeah, I did see some commentary out of Dick's saying that it'd be accretive in the first full year. So obviously a little too early to tell at this point, but let's see how this plays out in terms of share price action today when Dick's actually opens. Alex Coffey, thanks so much.